Okay. Welcome to session number 2 of the Temple Beth Shalom Men's Club series, Life and Death Decisions in the Second Half of Life. Special thanks to Rabbi Ed Weinsberg, Men's Club Program Vice Chair, and to Elliot Korn and Joel Servitz for their Zoom technical expertise. I will now turn the program over to Rabbi Ed Weinsberg. Thank you.
Yes, I want to thank you, Marshall, for hosting the Zoom session tonight. Without you, we wouldn't be here. Tonight's session, as most of you know, is entitled, Will You Outlive Your Income? Subtitle, Making Sure Your Finances Last a Lifetime. Our presenters are Lauren Rudd, who's Managing Director of the Rudd International related Raymond James Wealth Management Group, with Joe Malava, a certified financial planner. And just a few more words about them, because they both led amazing careers. Lauren is a 50-year veteran of Wall Street. His experience encompasses portfolio management, investment research and analysis, investor relations, and communication. He is a nationally recognized Wall Street newspaper columnist. He has a column called Streetwise, which some of you rather have no doubt read at least once a week in the Herald Tribune for years now. He's considered an expert trial witness on investment fraud and is a nationally recognized public speaker and radio television commentator. As for Joe Malava, he's worked more than 24 years in the financial service sector. Joe, at one time, was a financial advisor with UBS and NFP Securities, and he ran 4 offices for Cigna Financial Advisors in Southern California. He has a lot to say, and each of these gentlemen will speak for 15 or 20 minutes each before we open it up to your questions. But again, as you just heard from Marshall, please use the chat room as things occur to you, either comments or questions. Gentlemen, you're on.
Good evening. How are you? I'm glad to be here. Ed, thank you for doing this. What I'm going to do is, regardless of your stage of life, I'm going to cover what I consider to be 9 rules of investments that everybody should adhere to when they're trying to establish a portfolio, either for the current time, for the legacy for grandchildren or children or grandchildren, or just their own retirement. Most of you probably are retired, you have portfolios, but from my experience over the years, I've seen a lot of mistakes being made by individuals who come to see me. They really don't understand what they should be doing with their portfolio. First of all, I'm going to cover these 9 steps briefly because in 15 minutes, I really can't, go into much detail. So to start with, discipline. One of the biggest faults people have with their portfolio is basically they can't leave it alone. They constantly want to improve it, change it, do something. They hear something on television, they read something in a magazine or read it in the paper, and they say, I have to do this. Don't. You need to have a discipline to leave your portfolio. If it's well-tuned, it's doing well, don't fool around with it. Don't mess with it. Leave it be. You also need to have discipline to avoid the common mistakes of people say, hey, this is an investment you have to go into. This is how you provide for your grandkids and your kids. This is what you need to do. No. Nothing has to be done immediately. Nothing has to be done instantaneously. Always step back, think about the problem. If necessary, get advice. Adversity to risk. One of the biggest problems that people have, particularly as they get older, is trying to avoid risk. If you're going to be in the equity markets, the stock, buy individual stocks, you're going to entail some risk. The objective is to keep your risk to a minimum. Not difficult to do. I will give you a couple just real quick tips. One, Always invest in companies that pay dividends. Secondly, invest in companies that are raising dividends. Our whole philosophy, my whole philosophy for many, many years has been build portfolios only with companies that have been increasing their dividends for at least 10 consecutive years. The average for our portfolio here is 23, 26 years. If a company has been raising dividends, that means they've got increased income. And if they've got increased income, it means they've got increased revenues. It provides a solid foundation for your portfolio. Money management, you need to control what you buy and when you buy it. For the most part, once a portfolio is built, there should be very little turnover, and the only time you should either add a stock is if you get additional funds, or sell if a company has a drastic thing like cutting their dividends. Then yes, you have to do something about the problem. Objectivity, I want you to be objective about your portfolio. I want you to look and say, hey, this company is not doing well. I should never have invested in it. Take your loss if there's a loss, but get out of the stock. Be objective when you look at your portfolio. Do not say, well, this company is going to do better if I hold it for another year or two. It never happens. Or if it does, it's very, very rare. You need to be objective about your investments. If you are, it puts you on a much straighter path towards the goals you're trying to meet. Ignore the crowd. One of the biggest problems I see is people listen to, hey, everybody's jumping in this company, everybody's buying this. One of the biggest problems you saw is that people are buying or investing in companies that were bankrupt. Why? Because everybody else was doing it. That doesn't make any sense. Following the crowd is a great way to lose money. Do not do it. Make your own decisions. Do not be influenced by people in the industry, people who are trying to sell you something, people are trying to make a commission off of you or fees off of you. No, there's nothing wrong. I'm a professional money manager. I charge a fee for my services. Yes, that's how I make a living. However, you want that to be a very small part of the expenses for your portfolio. Be flexible. Understand that companies vary in their abilities, the markets vary. We have seen for the last 2-3 weeks, volatility in the stock market. This happens. Is it a reason to be panicking? No, absolutely not. If you look at the economy over the last 40 years, what do you see? The economy's been growing. If you look at the stock market over the last 40 years, what do you see? The major, let's use the S&P 500, the index has been increasing. Are there dips? Of course there are dips. Right now we're seeing a small dip. Does this mean it's time to panic? No. You just wait it out, understanding that dividends will cover about 2.5% of your return, and the rest will come in time. You must be patient with your portfolio. Investing is not a 3-month proposition. It's not a 6-month proposition. It's not a 9-month proposition. It's a 1 to 2 to 3 year proposition. Don't fight the Fed. If you're going to try to guess what the Fed's going to do, you're going to lose. Interest rates may go up, they may go down. Right now, the direction is that we'll not see increased interest rates for at least another year, but the Fed is going to pull back on putting money in the economy. They're going to buy less bonds. Is this going to have an effect? Yes. But if you think you can outguess the Fed, you are making a dramatic mistake. You cannot. And the Fed is not going to tell me, you, or anybody else what they're going to do in advance. Don't fight the tape. The tape is what we call the day-to-day activity on Wall Street. Wall Street is dropping. Okay, you look at the indexes during the day or in the evening after the market closes, and you see, hey, the market's dropped. Do not panic. Don't say, hey, Market's down, I'm going to buy in, or if the market's rising, I'm gonna wait for it to come down before I buy in. We don't do that. I don't recommend it. My advice to clients and non-clients alike, what I teach my students is, look, if you want to invest in the market, if you've done your research about a company, and if you like what you see in your research, then go ahead and buy the stock. Do not worry about what the markets are doing at any given time. Remember, always, you are not buying Wall Street. You're not buying the S&P 500, I hope. You're not buying anything except an individual company with whom you have confidence you want to share in their business. That's the purpose of investing. Use history as a guide. What I tell clients is forecast. It's neither legal nor ethical to forecast what the markets are going to do. I can't do that. Nobody can. Here's what I can do and what I recommend you do. You can look at 5 years of historical data. You can get down to whatever granularity you want, but with 5 years of data, you can, with fairly simplified mathematics, or even a pencil and a ruler, you can make some judgment call as to where a company is going, where the revenues are going, where the earnings are going, where dividends are going. And so you can use history as a guide and make your decision, invest in your company, but please, 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 give your company an opportunity to do what it does best, which is make money. This is not something that you can determine in a quarter or 6 months or 9 months. What I tell students, what I tell clients is you have to give a company a year. If it doesn't perform in a year, but you still think the company is on solid ground, give it another year. Let me give you one last case and I'll turn it over to Joe. 2 years ago, we invested in Goldman Sachs. That was one of our stocks in our portfolio. Goldman Sachs was doing terribly. There's no question. I got phone calls. Why are you investing in Goldman Sachs? I said, because they are the oldest and best firm on Wall Street in terms of brokerage houses. They are the gold standard. Today, Goldman Sachs, 2 years later, is our best performing stock in our portfolio out of 41 companies. They were up over 46, 48% this year. This is what you have to do. You have to have patience. If you're impatient, you're worried about risk, you can't sleep at night, then do not invest in the stock market. It's not for you. If you can handle the risk, go ahead. Okay, I'm now going to turn it over to Joe, and he's going to tell you a little bit about financial planning in this lifestyle.
All right. Hello, everyone. Thank you for having me today. And Lauren asked me to speak about financial planning. And in general, everyone should have a financial plan. If you have not run a financial plan by a certified financial planner, you should do it. If you have your own CFP in the group that you work with, see them. If you don't, you can get to me through Lauren. We're happy to run a financial plan for you. But you know, the simple old adage is, if you don't plan on where you're going, you're going to get wherever it is that you get. So you really need to have that guide for you. Now, as I look through, I see a lot of you are retired already. And there's really 3 categories that are very important when you look at financial planning. The first is, and this would probably apply to your children, your grandchildren, or anyone that you know, younger friends, it's pre-retirement. And pre-retirement, again, they need to know where they are going. So I'm going to give a quick story about a couple clients that have come in. There was a couple that came in their 50s. They had never run a financial plan before, but of course he had a spreadsheet. Everyone can work an Excel spreadsheet. And he says, according to my Excel spreadsheet, we should be fine. And I said, okay, well, let's see your spreadsheet. And he shows me the spreadsheet. And I said, you are correct. According to your spreadsheet, you should be fine. But when we ran the numbers in the financial planning software, the thing that he did not consider, and most people do not consider, is inflation. And inflation is real. It may not hit you every single year, but it might hit you 3 years at a time, 5 years, where you say, my money's just not going as far as it used to. And so the software will take inflation into account. And also people need to understand that different types of expenses have different inflation rates. You might have a 2.5% inflation rate on your normal expenses, but healthcare is a much higher inflation rate, and you need to account for your healthcare expenses. So this couple that came in their 50s, they had their Excel spreadsheet, and when we ran their financial plan, the thing that they did not account for was his wife's healthcare expenses or healthcare insurance until she reached Medicare age. And that was going to cost them about $25,000 a year. So it was throwing off their financial plan for 4 or 5 years because she was younger than him until she reached the Medicare age. So after seeing this financial plan, what I don't know if you want to mute everyone and then I'll hit unmute.
Who is she? Why is she so important?
Okay, I'm going to mute everybody again.
Yes, and then I'll
Yeah,
unmute.
those are just names on the list.
Okay, now I can tell my story. Sorry about that. So what they ended up doing was she saw the plan, the wife, and she said simply, honey, guess what? I just need to make $20,000 for 3 or 4 years. You know what? I have the skills, the ability. I'm going to do that. We'll save up that money and that will cover my healthcare expenses. She did actually end up going to work. She found a little part-time job that was happy for her, or that made her happy. But incidentally, he ended up inheriting some money, so he didn't really need it anywhere anyways, but she kept the job because she was happy working. She wasn't bored at home anymore. But the moral of the story was that by seeing the plan, they saw where the gap was and they were able to make the changes together in concert. And so sometimes when you have the spreadsheet at home, it looks good to you, but that's good. Important to tell your children, tell everyone, all right, well, maybe you should see what a certified financial planner will show you, because we're going to show you certain expenses that you may or may not have considered. So that's pre-retirement. When you enter retirement, that's a very, very, very important time when you decide, I'm going to stop working. Where is my cash flow going to come from? How am I going to replace all of my paychecks? And so that's a very pivotal time. And a client just came in recently, and actually he's been a client for a few years, but he's now retiring, and we're going to transition all of his assets into income producing for him so that he can live off of the assets that he's gathered. But in his particular situation, he's kind of close on his assets, and he's one of those people that just doesn't want to have any debt. He says, I pay for my car as cash, and I own it for 15 years. I pay for my house as cash. I do this, everything's cash. But when I showed him his financial plan with the way his wife spends, I'm sorry, ladies, but it just, in this particular case, it could be men. It's just in this particular case, it just happens to be that she does spend a lot. It wasn't wise for him to spend the amount of cash that he wanted to spend on a car. And it wasn't, a $30,000 car. He wanted to buy this car cash. And I showed him what it did to his financial plan and what it did to his cash flow. And it made it a little more questionable at first when he looked at the vacations he wanted to take. Once you start looking at how you buy vehicles, how much you spend on vacations, what you need to do for insurance, and all the different things that you want to do in your life, pass money to your children, pay for life insurance premiums, you add it all together. And I said, it's 0% financing. Why don't you just spread this out? If you just spread this out a little bit, then it makes your financial plan look a lot better. In his case, it made everything look successful, and our software runs the probability of success. The probability of success went up to 95% instead of being a lot lower. Now, on the other side of the coin, I have another gentleman who was entering retirement, and he owns a Budweiser distributorship. And he has definitely, he won't spend the money that he is selling off on some of his shares from the Budweiser distributorship. His situation is different because he's entering retirement, and what he needs to consider is, what is he going to do with his money to make a difference in this world? And so for him, planning for retirement is a foundation. It's going to be what he can do to help other people with this money that he's never going to spend. So that's a whole different set of circumstances, but both need to look at, what are they going to do with their money? How are they going to live off of it? How are they going to make a difference in this world? And what is the best way to use that money? And again, the gentleman that is going to start a foundation, what is the best use of his money is the best use of his money to give it to the tax man, or is to help the community around him. And he decided it's better to help the community around him, especially once he looks at the numbers. So it's our job as a certified financial planner to help him and guide him through those different choices and get him to the right people. The third category is where you are happily in retirement. And I'm going to give a quick story because I've been communicating with this particular client quite a bit. We ran their financial plan. Everything has been successful. The wife has always been worried because her husband is about 12 years older, and some of the investments that they have are income generating, but the asset isn't necessarily hers or theirs. He is now ill. He's in his 80s and he is ill, and he has a heart condition where, you know, they have hospice coming, and she has reached out to me several times saying, you know, I know, and we talk about his condition, but then she said, what is going to happen to me? And she wants to make sure that she's okay, and he wants to make sure that he's okay. They're both, you know, on the Zoom call like this saying, all right, Joe, let's run through this again. And because their worry is, and this is everyone's worry, I want to make sure that he or she, whoever it is, my spouse, has the single best healthcare that they can get when they run into situations like this. So whatever that cost is, I'm going to pay for it. Do I have the long-term care? If not, how am I going to pay for this to make sure that, you know, Bobby or Susie is okay? But then after, you want to make sure that the surviving spouse lives just as comfortably and is used to the, you know, way of life that they were before, and you pass on the money that you'd like to pass on to your children. So, you know, I understood her concern. We had a lot of conversations, but we had run the financial plan. We just ran back through the financial plan, and I kept saying, you're okay. And we had to do this several times, and she said every time, okay, thank you. Because, you know, I'm worried, I don't know what to do. And after someone passes, it's a very, very difficult time for whoever is left. And, you know, having that financial plan and having the financial backing of someone like Lauren or myself to sit there and say, guess what? You don't have to worry about it. We'll do what we need to, because most people don't even want to deal with it. They'll say, Joe, I don't even want to talk to you. If there's something I need to sign, I need to take care of. And I'm sure you've experienced this. Give it to me, and I will, and you know, I'll sign, I'll take care of it, but I don't even want to talk to you. I've had some clients who say, I can't come up to your office. I don't want to see you because it will remind me of Bill. You know, it's a gentleman I'm thinking of, will remind me of Bill, and I just can't come up to see you. So the important part post-retirement and your financial plan is, do you have the wherewithal to make sure you get the best health care, and how are you going to pay for it? Then second part is, after you pass, is the money going to pass in the best way to your children, the way that you wanted the money to go, in the most tax efficient manner? And do people know how to handle that and make sure that that wealth transfer occurs the way that you want? So that is, those are sort of three different stages: pre-retirement, you know, retirement planning, and then I'll call it post-retirement financial planning. So with that, I think that concludes my portion. I think we will open it up for questions if that's what the
Before
format
that,
is.
I want to make one last comment, and that is, I cannot stress, look, I'm 76 years old. I understand the problems most of you have. I can't stress to you enough to make sure that you have put in place a program for what should happen should one spouse pass. Generally, it's the male, because he's usually older, and he usually, according to statistics, he usually goes first. I'm 5 years older than my wife. I expect I will probably pass out of this world before she does, but I've arranged it so anything happens to me, whether it be accidental or my time up, then my wife knows exactly where to go, what to get, what you can expect, and how that money should be amortized over the remaining years of her life, and how it should be passed on to her kids and my kids, except, you know, that we had these kids before we met. So everybody's treated fairly. One of the biggest problems you see is that when one spouse passes, there's a fight for assets, and God forbid both parents pass. The kids could be the friendliest group of kids you ever saw, but when there's money on the table and the parents are gone, it's a cat fight. Just keep that in mind. It can't be helped. I've seen it time and time again.
Yeah, while we're not attorneys, you need to make sure that you have your trusts in place. The last thing you don't want to pass away. I think it's called intestate, where you have to deal with the will, because then anybody can show up in court and fight over the assets. And I recently had a client that passed away, and the children were doing exactly what you were talking about, fighting over the assets. But
we had one client. The husband died. He was, of natural causes. The wife died unexpectedly. They left $2 million to their daughter. A year later, she's got $30,000 left. Most of it went to casinos. This is not what you want to see. Ed?
I think that we do have a question in the chat room. And the first question is, are you in favor of revocable trusts?
in general, yes, that's exactly what we were talking about. That will help you lay out how you want the assets to pass once you are gone. And you have controls over the money once you are gone, where it goes to. So if you have a child that, or would not be responsible with the money, they can have it over a period of time, and they don't have access to it immediately. And, it's one of the best tools to pass on wealth, keep the wealth within the family, and pass it on from generation to generation. So the answer is absolutely. The client that recently passed away did have a revocable trust. So while the children were calling me, trying to access and fight money for the money, I sent them right to the attorney and said, well, you're gonna adhere to whatever it is that the trust says. And so the parents' wishes were being honored.
Okay, thank you for that answer. I don't see any other questions in the chat, so I am going to, wait a minute, here's a question. Hang on. At what point do I need a trust?
At any point in which you have a significant amount of assets that you can't title on transfer on death, or if you believe there is a need to control the way the assets are dispersed to the beneficiaries, then you should have a trust. So, I mean, in general, most people should, because the trust will avoid probate. Now, there are some other mechanisms that you can use, but again, we're not attorneys, but in general, most of our clients have trusts, and most attorneys will do a trust package that includes your healthcare surrogate, healthcare power of attorney, your general power of attorney. That whole estate planning package is very important besides the trust. But if you end up in the hospital, you want the right people to take care of you. You want the right things to happen. So it isn't just the trust. There's a whole thing a bunch of documents that are estate planning documents that are important for your care, while you're alive, and then after when you're gone.
Thank you. I did miss a question. Would you discuss how we should diversify our investments?
Well, the way I look at it and what I've done over the years, I don't believe in sector analysis. I don't believe in buying one from this pot, one from this pot, one from that pot. What we do is we make a list. In our case, it's 70 companies. In your case, it could be 10 or 15 companies, 18 companies, whatever you want. We make a list of companies that meet our criteria. And then we select from that list so that we have diversity in the portfolio. But it's up to the individual. For example, we have Intel, we have Microsoft. They're both in the same type of industry, the computer industry. We just added Scott's turf builder, fertilizer, whatever you want to call that company. They're totally uncorrelated with anything, but we did not put them in the portfolio for that reason. We put them in the portfolio because when we analyzed the company, we said, this is a good company, the growth prospects are excellent, we're going to add them to the portfolio. The fact that they have zero correlation with the other stocks is just sugar in the cake.
Okay, do you recommend annuities, fixed indexed, not variable?
Each investment has its purpose. And the only issue that I have with fixed index annuities now is that most of the return that you can get from a fixed index annuity is based on the 10-year treasury. The 10-year treasury is at historical lows, which means the return on your index annuity will also be at historical lows. Even though they say there's part of the index that you can get, the reality is your return will not be more than 2 to 4%. I've seen a lot of them now where people bring them into me and the max they can make is 2%, 4%. And they're generally illiquid. The other potential problem with annuities is when you pass. And again, I have this exact situation with a client right now where she just passed away. Remember that if the annuity is the investment is a non-IRA asset, so it's not a qualified plan type asset, and so it's just normal money, let's say trust assets, you're tax deferring it. So let's say you invest 100,000 and it grows to 200,000 and then you pass. Your kids have a $100,000 ordinary income tax bill on the gain. There is no step up in basis. So unless you're with a good financial advisor that knows how to spread that out over 5 years, some of them will just take the assets and the kids think, oh, it's found money. Okay, I'll pay the government and I'll lose $30,000 in taxes on this distribution. You worked hard for your money, and the kids and the financial advisor have to appreciate that what you have gathered and amassed, that you want it to go to them in the most efficient manner. So besides the fact that you may not make money, the index annuity also can be a tax problem, but that's all annuities. So, they have their purpose, but they're best used with IRA assets because they're already deferred.
I want to take a little different viewpoint. We do not sell annuities. We're licensed to do so. We never have, we never will. I do not like annuities for a variety of reasons. And if you ask me, give me half an hour, I'll explain the reasons to you. There is one exception. There are certain annuities where you can use our portfolio within the annuity that increases the returns. It's a very specialized situation, generally for people in the upper wealth brackets. But other than that, I personally dislike annuities. I dislike mutual funds, and I dislike ETFs, exchange traded funds, because you have no control over what you're investing in. And in my opinion, that's wrong.
Different question, a different field. What if we currently don't have long-term care insurance? It is so expensive. Do you have any suggestions or alternatives?
Yes. So when it comes to long-term care, you have to recognize that there's different kinds of long-term care. So there's the traditional long-term care insurance where you pay your premiums and you get a stated benefit of, let's say, $400,000, or they'll say $200 per day to use it that way. The problem with that is if you just pass away and you never use your long-term care insurance, you paid that premium for a long period of time and you received nothing. Then there is life insurance with long-term care. So you purchase life insurance. And what they'll say is, I purchased $200,000 of life insurance, but by the way, you have $200,000 worth of long-term care. In that case, at least there is some benefit that you're getting for the premiums that you are paying. Whether you live or die, you're going to get some benefit for that. And for example, again, on that, it was $200,000 of death benefit. If you used $100,000 for long-term care, then you pass away, then that means your beneficiaries get $100,000. There's also a hybrid policy, which is you get a long-term care benefit of, we'll say, $400,000. They will give you $200,000 in a death benefit for your beneficiaries, and maybe you put in $100,000. I'm just giving examples. And what that policy says is, well, if you decide you change your mind, you can get your principal back of $100,000. So that's what we call a hybrid policy, because you can get your money back if you need to. You have a death benefit, but really the purpose is long-term care. Most people are going towards that hybrid policy. And by the way, the hybrid policy is simplified underwriting. They only ask you, I think, 15 questions. And if you pass those, you can get the benefit. Then there's another kind, which is because I know you realize that the cost is expensive. There are some fixed annuities that will give you a long-term care multiplier. What they'll basically say is we will give you 2 to 3 times, maybe 4 times max of what you invested to be a long-term care benefit. So for example, let's say you get 3 times, you put in 100,000, you have $300,000 for a long-term care benefit. So it is expensive. There are different ways to get at it. And, so there's a lot of different vehicles. So it's best to talk to someone to figure out what's the right thing for you is what the answer is. But yes, it can be very expensive.
Thank you for that answer. Here's another question. If beneficiaries have been named for an IRA, does it transcend probate or taxes?
Yes, but well, not taxes. It does bypass probate. So if you list your beneficiary on life insurance policies or qualified plans, it will go directly to the beneficiary. But again, you have to remember taxes, taxes, taxes. So it used to be that your kids could spread it out over their lifetime and take a distribution, like a requirement of distribution, but they changed that law. And now your kids or beneficiaries have 10 years to take that money out. This is still a potential problem. The client that I'm telling you about with the Budweiser distributorship, he's 52, he's going to retire, he's going to pay all the taxes on his IRA now. The reason is he's aware when we ran his financial plan, how big that IRA will be when he passes away later on. And it's a giant tax burden for the kids. So he's trying to do away with that now. So one thing to remember is the kids will get it. You're not bypassing the tax man. But there are strategies in which you can decrease the taxes. And that's another conversation another day.
Just
Loan taxes, but you can't eliminate them.
a quick question. We do have a member here of the audience whose name is Lauren also, and he wanted to mention the fact that he says, I love your name. I'm a boy named Lauren too. Same spelling also. I just thought I'd throw that in for a little bit of humor. Here's the question.
I saw his name on the thing on the screen here. Yes.
Okay. What is the cutoff if your portfolio shows a major downward trend of 20% or more?
That's sort of an easy question to answer. I can't recall when portfolios took a 20% hit, except in 2008. Our portfolio was down 19% roughly. S&P was down 38%. Here's the key. We made it all back in 1 year and then some. Why? How? What caused it? Well, we made it back because the investments were still good investments. The companies were still good companies, and their products were still being bought by their customers. So yes, the markets were down. That was sort of mass hysteria. The reason it took the S&P so long to come back is that that's 500 companies that are in there, and some companies got hurt a lot more than others. That's the only time I can recall, other than 87, when there was really a major drop in the market. A correction, quote unquote, of 3, 4, 5% is really nothing to worry about. People continually ask me, what happens when the market crashes? I do not have a definition of crash. The only crash I know about was in 1929. I was born in 45, so I missed the party. There'll be dips in the thing, but people come to me and say, I don't want to lose all my money. I can't think of a situation where an investor would lose all their money if they have a solid performing portfolio. Yes, I have seen money managers lose clients' money. I got a couple of examples I'm not going to now, but I've seen it where they lost 80, 90% of the portfolio. But that was for the wrong investments. And the client should have known better and cut it off. But if you have a solid portfolio of blue chip stocks raising dividends for at least 10 years, the chance of losing all your money, in my opinion, and I stress in my opinion, is close to 0%.
I think that the beauty of Lauren's philosophy is that, you buy a good, healthy company that is paying you cash flow via a dividend. Even if the market goes down, though, that's usually where the money runs to, is the companies that are paying a good, healthy dividend, because their cash flow is okay. Those companies are healthier. They are worried about growth, but growth isn't the sole determinant of their return.
But remember, the key is raising dividends. You only, in my opinion, should be looking at companies that have been raising dividends. In our case, we use 10 years as the goal. So if you haven't been raising dividends for 10 years, you're not under consideration for investment in our portfolios.
Getting back to long-term care, this is an interesting question. If we are already in our 70s and have had traditional long-term care, is there any sense in making a change to a different long-term care vehicle?
That is a individual by individual basis. You would need to, take a look at hypotheticals, and you'd have to actually, sit down with us so we could do a proposal for you to see if it's worth it. We might say that. So the answer is maybe yes, maybe no, just depends on you and your particular situation. What's been happening lately. If you've had that long-term care policy for a long time, you probably have a good one that it's very hard to get right now. I've seen a lot of people with, here in Lauren's office with Lauren, that have come in and they had older policies and they said, should I change from this? When I send that to our long-term care department, they say, no, don't get rid of that. You can't get a policy like that today. They might be raising the premiums, but they're still far from where the premiums would be if you bought that same policy today. So the answer is maybe, you have to look at your own individual situation and see what price is out for you.
This is why using a financial plan for somebody like Joe is so important. We have clients have a lot of questions. One of the first things we suggest to them is, let's do a financial plan. Let's see where you are, what you have, where you want to go, and how you plan to get there. Then we can do our part with the investments, and Joe can do his part about looking at saying, hey, here's where you're at. This is what needs to happen or should happen, and let's go from there.
Any advice about physical gold as a hedge against disaster?
I'm not quite sure what you mean. You mean physical assets as opposed to equities?
The question is, any advice about physical gold? I would imagine that the question means holding gold coins, gold bullion, or whatever. That would be my interpretation.
Yes, that's my question.
Okay.
I'm totally opposed to that for the following reasons. Gold does not pay dividends. Gold is a metal. Gold is worth only what somebody's going to pay you for it. It's a metal. It has no value unless somebody tells you, I'm going to pay you for that. I have never invested in gold. I have discouraged people from buying gold, and I still do. And if you look at the returns of gold over time, allowing for inflation, the returns aren't very good. The thing is you have a gold coin or gold bar, and I've got a client, he keeps one of these multi-kilogram gold bars in a safe as an insurance policy. But the thing is that when you go to sell it, first of all, you're going to get a discounted rate for it. And second of all, it's a metal. You're better off buying copper. At least copper has a value. You can use it in engines and cars and houses and what have you. Gold's it's a metal. Do I have a gold? Yeah, I got one $5 gold piece I bought from a client who wanted to get rid of it as part of an estate. Otherwise, no, I do not believe in gold. I never have.
So my theory on gold is because you are the question is correct in the event of a disaster. In the event of a disaster, you need weapons along with your gold. You can see, otherwise you're going to lose your gold. It's going to be gone. Someone's going to take it. So but there are tax advantages though to holding gold, when you have the physical gold. But as Lauren said, the long-term returns really are what you look at, over a long period of time.
There's a question that I'd like to rephrase a little bit, and that is financial planners can charge fees in a multitude of ways. Sometimes it's on an hourly basis. Sometimes it's based upon a percentage of the portfolio, or perhaps a commission off of a product that is sold. For the general average person, I'd like to hear your thoughts about what you think. There's another question which I thought was funny. What you think is the way that a consumer such as us should investigate and pursue a financial plan?
Well, so for example, with Lauren, we will charge $1,000 for a financial plan, unless Lauren says to me, they're a good client, don't charge anything. And also for our clients that are normally paying a fee, we believe that's part of the service that we should be providing. So, it depends on your relationship, and, the firm you're with should have a certified financial planner on board somewhere, that they're working with, because the two need to work in concert, together. So, but generally you unless you have an extremely complex financial situation, and in that case, people are more than happy to do the financial plan, you probably shouldn't be paying more than $1,000.
There is one exception in my opinion to that rule, and that is we have some very, very wealthy individuals whose financial plan and estate plan, it moves from a financial plan to a estate plan, is 40, 50, 60 pages in length. This gets to be a little bit more expensive. We don't do it. I don't think Joe does it. We do have somebody in our office here who can do it, but it depends on the extent of your wealth, to be very honest.
Yep, he's correct.
Now, I know that that your company would not invest in this, because certainly there's no a 10-year dividend plan or history off of marijuana companies. But do you think that in the future, marijuana companies will generate more than just a good high? It can generate a financial high. In 10 years from now, will I be coming to you and you'll say to me, Marshall, let's invest in Rabbi Ed Weinsberg's marijuana factory because it's got 10 years worth of dividends?
All right. As of right now, we are not allowed to do it because marijuana and associated others type drugs are against federal law. We are federally regulated. Now, I know there's 14 states that have approved marijuana for recreational use. Nonetheless, Raymond James and most brokerage firms, not all of them, say, hey, because of federal regulations, we cannot do it. The only exception made is there's a couple companies that are listed in New York Stock Exchange, which you can buy the shares of. But that's the only exception I can think, and Raymond James would probably frown upon that. So personally, we don't touch it unless the federal government says it's now legal. That brings a whole different situation. But again, those companies would have to show me 10 years of dividends before I would even consider them.
Okay, here's another question. It's kind of a trendy question. I know that you don't invest in it, but kind of as a sidelight as we're winding down. What do you think about Bitcoin? Is that the wave of the future, or is that a passing fad?
All right, we may have differing opinions. Bitcoin to me, now not the strategy used in Bitcoin, what's it called? The methodology they use, but Bitcoin itself to me.
Blockchain.
Blockchain is that's different, but Bitcoin itself, to quote Warren Buffett, is a Ponzi scheme, basically. We do not mess with it. Raymond James does not mess with it. So we stay away from it. But I understand its popularity. I understand why people do it. I have several acquaintances who have made, quote, a lot of money on it. I have never seen the cash, but that's what they tell me. So my personal opinion is I wouldn't touch it, but once again, it's personal opinion.
It's the wild, wild west. It is, illegal or just unregulated market manipulation. They just get behind something and it just pushes the price up, or it'll push it down wherever they want. If you ever look at the number of investors, the number of people that are holding the coins, it's really important, because there's some of those coins, there's hardly anybody owning it. It wouldn't take more than 2 people with a decent amount of money to manipulate the coins. So there's a lot of manipulation happening with cryptocurrencies in general. And so there's a number of ETFs that they're trying to get approved, and that could change things in the future, but that will require regulation. And so there's a lot of regulation that needs to hit that market, and that will change it altogether, and it will change the return ability of something that is, if you take Bitcoin, for instance, it is more akin to gold, that is what they mimicked. The amount that can be mined and that can be out there is the amount of gold that is in the world on Earth. So
Remember, we're trying to keep risk to a minimum. I mean, we understand there's risk for investing, but why go out of your way to incur additional risk? If you invest in what I consider to be reasonable securities, your risk is kept to a minimum if you do proper research. Why go out of your way to find a pitfall that you can fall into?
Okay, well, I think I don't see any questions from the floor. So, and I don't see any more from the chat, but I will just ask my one question. And that is this: with the rising debt that the United States government is facing, does that affect, in your mind, what your mix would be, your balance of whether it be of the stock equity balance, or the stock bond balance, or are you just going to stay the course independent of what the debt is?
Simple answer, independent of what the debt is. Understand that the national debt, 70% of it is held by US citizens. It's not held by foreign companies, foreign countries, or individuals abroad. It's held by US citizens. People constantly bring up China. China's amount of the national debt that they hold is very small. They unloaded most of it. If you have savings bonds, if you have government securities, the number one risk-free investment is US Treasury securities. That's national debt. If you're looking for national debt to be paid off, not in my lifetime, and probably not in yours. Now, the deficit's a different issue. That's a different question. We'll get into that, some other time. But no, am I worried about the national debt? I'd like to see the increase decrease, but I do not lose any sleep over it.
Okay, well, thank you very, very much. We're rounding up, approaching the end of the hour. And as promised, I will turn this program back over to Ed Weinsberg. And I want to thank our 2 speakers tonight for a very informative conversation. And I'd like to express my thanks to the audience for their comments and questions, some of which were sent privately to me and were exceptionally pithy and witty. And the gentleman knows who I'm talking about. And I want to thank everybody for keeping me entertained. And I want to thank you, Mr. Rudd and Joe, for giving us a wonderful lecture with that.